So, if you've looked at your portfolio in the last 24 hours, man, you felt it. A brutal, just gut-wrenching sell-off that seemed to pop up out of nowhere. Now that the dust is finally starting to settle, the big question isn't just what happened, but what happens next. Let's break it all down.
Yeah, this is the question on literally every trader's mind right now. It doesn't matter if you took a hit or if you're on the sidelines looking for an entry, understanding what happens next is absolutely critical. And that's exactly what we're going to unpack.
Okay, so first things first, let's get a really clear picture of the immediate aftermath, because understanding the reaction to the crash is the key to figuring out what's going to come next.
What we're seeing right now is just this classic emotional gut reaction. You know, as traders in different time zones are waking up to these massive overnight losses, their first instinct is pure fear. They rush to move their holdings onto exchanges, just desperate to sell before things get any worse.
And this wasn't just some small ripple, no way. The scale of the panic was absolutely massive. A staggering 41,585 Bitcoin were moved to exchanges at a loss. I mean, just think about that for a second. That means tens of thousands of holders were so scared they were willing to lock in a definite loss just to get out. That's not just selling. That's straight-up capitulation.
So what actually caused such a sharp, violent drop in the first place? Well, while some news might have been the spark, the real engine of this crash was something much more mechanical, a leverage cascade. At the peak of all the chaos, prices swung a massive 16% in a single day. To put that in perspective, that kind of volatility is a complete nightmare for anyone trading with leverage, which, is basically trading with borrowed money to amplify your position. And a move this big has a devastating and automatic consequence.
Here's what that 16% drop really means. Anybody who was using more than 6x leverage was instantly wiped out. Poof, gone. Their positions were automatically sold by the exchange. It wasn't a choice, it was a forced liquidation. And this is where the real damage began, because it didn't just happen in isolation.
This creates a really dangerous chain reaction. It all starts with one price drop, right? And that liquidates the traders with the highest leverage. But their forced sales push the price down even more. And this new lower price then triggers the next wave of liquidations, which, you guessed it, pushes the price lower still. It's a domino effect, a self-reinforcing cycle that just violently flushes all that leverage out of the market.
Okay, so that's what happened.